Well, I think there's a big debate going on. And if you look at the second, third, and fourth quarter of last year, you look at the mega caps and the rest of the stocks in the S&P 500, you'll see mega caps in the second and the fourth did very well. And the smaller cap stocks did very well, much better than the mega caps in the third quarter. I think there's a little bit of a tug of war evolving here. And if we're right, the most massive concentration in the market in history, worse than the Depression, is probably going to give way to a broader-based bull market.
There's a big debate happening on Wall Street right now. For months, mega-cap tech stocks have been the market's backbone. But could we be seeing a shift towards smaller-cap stocks in a broader bull market? In the recent trends, mega-caps dominated, driving the S&P 500 higher during the fourth quarters of last year, and smaller-cap stocks surged, outperforming the big names during the third quarter of last year. The market seems to be at a crossroads, a battle between concentrated leadership and broader market participation. The current market concentration is at levels worse than the Great Depression, with a handful of tech giants holding an unprecedented amount of market weight. But history tells us that markets eventually broaden out. If that happens, we could see more small and mid-cap stocks rally as capital flows away from just the biggest names. The battle for market leadership is far from over, but if history is any guide, we could be on the verge of a major shift in where the gains come from.
We're seeing that in our portfolios, and it really did start right around, actually, the day after the election. And I think one of the most important things is going to happen is regulations coming down. Even in AI, in the United States, their regulations...
We're witnessing a pivotal moment, not just in the markets, but in the future of AI itself. Ever since the election, there's been a noticeable shift in portfolios, and now the looming question is regulation. AI is in the same explosive phase as the internet was in the early 90s, full of promise, potential, and unknown opportunities. Back then, no one fully grasped how game-changing the internet would be. But here's the key issue. Regulation is already creeping in. We don't even know what we have yet with AI. The excitement is off the charts, but heavy-handed regulation could slow down one of the biggest technological revolutions in history. If history repeats itself, AI could be the internet boom all over again, but only if we let it evolve before putting on the brakes.
Well, I think you've got the president on your side when it comes to that in the States. I want to come back to kind of this idea of the hyperscalers here. You're famous for your beta strategy, especially when it comes to the tech space. I think it's fair to say that the highest beta right now is in some of these tech names, in Nvidia, in Microsoft, in Google. Just looking at some of the moves we've seen in the last 24 hours, not to mention the last 12 months or so. Why not increase your holdings for more exposure to the hyperscalers?
Yeah, we do think, we do own Meta and Amazon in our flagship, and we own more of them in our other more specialized portfolios. And in Europe here, we have an AI and robotics fund, and we hold probably most of them because they are going to benefit from the declining cost in AI. And even Meta, who was really the open source leader. DeepSeek is open source. I think Meta is saying, wait a minute, what's going on here? And they're going to use some of the techniques, the algorithms that DeepSeek has used to improve their own platform. So we're not negative on them. We think that the neglect of the rest of the market has been extreme, and that is going to change. That the strongest bull market out there is a broad-based one. A market favoring 6 or 7 stocks alone is not a strong bull market. And so if we're right, the bull market will strengthen out and gain momentum, rewarding smaller cap stocks than we have seen thus far. Yes, if you look back at the Depression, I'm not going to get all of these numbers right. What you'll see is the massive concentration took place until 1932. Yeah. At which point the market started broadening out. And small or mid-cap stocks back then way outperformed large-cap stocks. And it makes sense. They had been absolutely destroyed during the Depression, which was binary. Is this company going to survive or not? With output down 30%, GDP down 30%. It is surprising to me that we got to an even greater point of concentration than the Great Depression. It tells you that in an underlying sense, there was a lot of fear in the market. and that investors were piling into cash-rich companies that, oh, by the way, had, a leg up perhaps in this new thing called AI.
The market is at a fascinating crossroads with big tech hyperscalers like Nvidia, Microsoft, and Google dominating headlines. Their volatility over the last 12 months has been off the charts, and their role in AI is undeniable. Many investors are doubling down on big names like Meta and Amazon, believing they'll continue to ride AI-driven growth and declining costs. Meta, for instance, has been a leader in open-source AI, but now even they are rethinking their strategy, looking to integrate cutting-edge AI algorithms from innovators like DeepSeek. History tells us that real bull markets thrive when they expand beyond the giants. If we're right, we're about to see a shift, where smaller and mid-cap stocks finally get their moment. Massive concentration of wealth in a few companies lasted until 1932. Then, the market broadened out, and small and mid-cap stocks skyrocketed. Those that survived the downturn outperformed the giants once the dust settled. We're more concentrated than even the Great Depression, a sign that investors have been playing it ultra-safe, piling into cash-rich tech titans while waiting for AI's full potential to unfold. Hyperscalers still have upside, but they shouldn't be the only bet in town. A broader-based bull market is stronger and more sustainable. Watch for shifts toward mid-cap growth stocks.
Productivity has been boosted to some extent, and you're right, it's very difficult to measure this. My background's economics, and in the 80s, productivity was a big question mark, and we saw how flawed the measurements are, and probably still are. So I can only tell you the rate of uptake is so much, is that enterprises are seeing a difference. Maybe if they're not laying people off, they're not hiring them. Mm-hmm. And we know that, and that's because these AI tools are making their own, especially engineers, so much more productive, right? So you just don't have to hire that next person. If you've seen the number of coding employees in the United States has dropped like a cliff. I mean, off a cliff. It hasn't dropped like a cliff, it's dropped off a cliff. And I don't know if you've seen that chart, so that very much has happened as engineers just become more and more productive. You know, one of the things that we're wondering is, okay, what part of the software stack will this, the traditional software stack, will this impact? And we think the AI revolution is what we see already losing share to some extent. It is still growing, but losing share is software as a service. And, you know, I think we're all paying very close attention to the revenue growth dynamics of these companies. A Salesforce.com, revenue growth isn't picking up. In fact, it continues to decelerate. I think it's next quarter will be, I think, 7% down from 9%. That's not what's supposed to happen here. And so I think that might be what you're referring to. Wait a minute, where are the top line dynamics? Where are they coming from? Well, I think we have a lot of entrepreneurs in a lot of garages or in R&D centers who are creating the next big thing. And, you know, we look at two profound ramifications of AI that we understand. We've been researching them for so long. The largest AI project on Earth is robotaxis, autonomous driving networks. We think that's going to drive $8 to $10 trillion in revenue globally in the next 5 to 10 years, up from zero.
AI is rewriting the rules of productivity, and businesses can't ignore the shift. Even though measuring productivity gains has always been tricky, especially since the 1980s, what's happening now is undeniable. Companies are hiring less, AI tools are driving efficiency at an unprecedented rate, and entire job functions are changing, especially in coding and engineering. Take a look at software engineers. The number of coding employees has fallen off a cliff in the US. That's not because demand for software is shrinking. It's because AI-powered development tools are making engineers exponentially more productive. The impact isn't just on labor, it's hitting the software industry itself. Software as a service, or SaaS, is losing market share. Its revenue growth is decelerating, expected to drop from 9% to 7% next quarter. That's not what should be happening in an AI-fueled growth era. If you want proof of AI's earth-shattering economic potential, look no further than robo-taxis and autonomous driving networks. AI-driven mobility could generate $8 to $10 trillion in global revenue in the next 5 to 10 years. That's 0 to trillions in a single decade.
Now, we believe that real GDP growth globally is going to accelerate from 3%, where it has been for the past 125 years, to 7 to 8%, if not more, thanks to the convergence among these technologies: robotics, energy storage, artificial intelligence, blockchain technology, and multi-omics sequencing. Now, why are we so confident about that? That sounds like an outrageous number. The consensus forecast is 3%. Well, the reason is, if you look back in history, you will see that about 125 years ago, 3 innovation platforms were evolving at the same time: telephone, electricity, and internal combustion engine. And what did that do to real GDP growth globally? It increased the rate of real GDP growth by 5-fold. We went from 0.6%, where the world had been over the 400 years, from 1500 to 1900. We went from 0.6% to 3%. That was a 5-fold increase. And now we're telling you, even though there are 5 innovation platforms evolving, with AI at the heart and soul of the acceleration in these technology platforms, that we're only going to see a 2 to 2.5-fold increase. We think that could be very conservative. And one of the reasons this is going to happen is because of productivity. Productivity is going to grow dramatically, and productivity is associated with low inflation growth as well. You can have higher wage growth if productivity is rising. So it's a win-win for everyone. And what a win-win means is wealth creation.
Hold on to your seats. Global economic growth is about to skyrocket. For 125 years, real GDP growth has hovered around 3%. We believe that real GDP growth will accelerate to 7 to 8% or even higher, thanks to the convergence of 5 groundbreaking technologies including robotics, energy storage, artificial intelligence, blockchain technology, and multi-omics sequencing. These aren't just innovations, they're revolutionary forces reshaping entire industries, from healthcare to finance to transportation. That number of 7 to 8% growth might sound bold, but history tells us it's not only possible, it might be an understatement. Rewind 125 years. Back then, 3 major innovation platforms, telephones, electricity, and the internal combustion engine, emerged at the same time. And as a result, global real GDP growth jumped from 0.6% to 3%, a 5-fold increase. Now we have 5 innovation platforms evolving simultaneously, with AI at the center of it all. Yet, we're predicting just a 2 to 2.5 times increase in global growth. The reason for this growth explosion is productivity. Higher productivity means lower inflation, which means sustainable wage growth, and which ultimately leads to economic expansion. It's a win-win scenario. Businesses become more efficient, workers become more valuable, and wealth creation spreads across industries and economies.
And what does that mean for the stock market? Well, if we're right, then the value associated with truly disruptive innovation during the next 5 years in the equity markets, we believe, is going to rise from $12 trillion to $140 trillion, more than tenfold. Now, you might wonder what is going to happen to the Mag 6 during that period of time. Well, the Mag 6 will probably do fine altogether, although some will be disrupted by this new world order. That said, we expect the Mag 6 to go from 16 trillion today to 60 trillion. So that's about a 4-fold increase, maybe a little less than that.
If these predictions hold true, we're looking at a historic explosion in equity markets over the next 5 years. The value of truly disruptive innovation could soar from $12 trillion to $140 trillion. A staggering tenfold increase. That's not just growth, that's a revolution. The so-called Mag 6, Microsoft, Apple, Google, Amazon, Meta, and Nvidia, will still be major players, but the game is changing. Today, the Mag 6 is worth $16 trillion. In 5 years, that number could hit $60 trillion. That's nearly a fourfold increase, but still far behind the rise of disruptive innovation. AI-powered industries are scaling at breakneck speed. Emerging technologies, robotics, blockchain, energy storage are unlocking new markets. New players are set to disrupt traditional powerhouses. The next 5 years could redefine wealth creation in the stock market. Now, if you found this video valuable and you want to diversify your investments beyond traditional stocks and bonds, I have just the thing for you. Even though I believe that investing in a low-cost index fund is the best long-term investment for the average Joe, the benefits of solid physical gold are hard to deny. I think of physical gold as insurance against unpredictable times, and I'm not the only one. In 2023, central banks added over 1,000 tons of gold to their reserves, the second highest annual purchase in American history. And in 2024, central bank got another 290 tons of gold in just the first 3 months of the year. If the biggest banks in the world are buying tons of gold, I'm sure there's a good reason for it. I found a company that allows ordinary Americans to own and securely store physical bars of gold as part of their IRA account. The best part is that they're giving away a free guide to teach you all about investing in solid physical gold. If you want to learn more about how gold can protect your retirement savings, just click the link in the description to receive a completely free gold IRA guide.